Joining me now, Ahmed Riesgo, Chief Investment Officer at Insignio. Ahmed, great to have you here. Thanks so much for joining us.
Thank you. Great to be here.
So we have some red arrows across the board right now. Walmart seems to be weighing on the Dow, down about 400 points. I'd like to kick things off by talking about retail because it's been a big week for earnings. We've now heard from some of the biggest retailers. After listening to all of them, Ahmed, what did you learn about the consumer this week?
Look, not much new, to be quite honest. We know that the sort of lower income cohorts, groups in the country are not faring very well. They're under pressure. We know affordability is the number one issue going into the midterm elections. So this whole concept of a K-shaped economy is very much a real one. And, a company like Walmart reporting today sort of the slowest sales growth they've seen in many, many years, it shouldn't be altogether surprising. I know the stock is getting hit quite a bit here at the open and in the pre-market, but this really shouldn't be much of a surprise. We know that really the upper income groups are sort of sustaining consumption across the country, and a lot of this consumption is AI driven. We know that that's not necessarily the case with lower income groups.
As we think about what that means from an investor perspective, where would you rather have your money right now? The consumer who has to spend or the consumer who wants to spend?
Well, I'll put it as a consumer that can spend. And the consumer that can spend right now is, one who's obviously highly tethered to the market. The market's done well, so the wealth effect has been very real. Like I said, the upper income groups that are not as impacted by the affordability issues that are ransacking those in the lower parts of the income spectrum, right? Those who are not affected when gas prices go up as much, food prices, because it's a lower share of their budget. So that's a segment that we think will continue to stay strong. It's one of the reasons, by the way, why we don't think rates are going much higher from here. I don't think the economy can tolerate it. And I think you've sort of seen that sort of being telegraphed by Scott Bessent with some of the actions he's done this week. So I think this is something that's very much in the minds of not just the government, but the central bank and other economic planners as well.
We'll get to this or that at the end of this, but if you had to choose between discretionary and staples, then you'd choose what?
Right now, we'd be choosing staples, yeah. And that's actually the market has kind of bet that way. So if you want to be contrarian, you would go the other way. Problem is that we really don't see a situation here where the economy kind of reaccelerates and rates come down substantially that would give an impulse to the discretionary sector. So we still think it's a little too early to make that rotation.
There are a lot of risks hanging over this market. There's the slowing consumer, as you've described. There's the potential for the Fed to raise rates. Doesn't sound like you think that's going to happen, but we do have bond yields climbing. We have oil near $90 a barrel. We have geopolitical turmoil. Rank those risks from biggest to smallest as it relates to this market.
Yeah, I think by far the biggest one is what's happening in the rates market. I think, rising yields is one of the reasons that both the economy and the market could be undercut. The legs could be taken out, so to speak. So this is why I think you're seeing already the government, through Scott Bessent, and potentially down the line with the Fed starting to take action to address this problem. But by far, that's, I think, the biggest risk, rising rates.
At what level on the 10-year do the legs get taken out of the market?
It's tough to say. Scott Bessent is a hedge fund, that's the world he comes from. So I think he's trying to get ahead of this problem before it actually becomes a problem. I don't think current levels are an issue. I think the worry coming out of Washington is that the trend continues higher, and then, above five and change, that could be a level that could be, difficult for the economy to sustain.
Every bull comes on and points to strong earnings as the reason this market can power higher, though. So do you agree? And are strong earnings enough to offset all of those headwinds, including higher bond yields?
Look, I think every bull comes on and says it, and sometimes that can be true. It really has been a historic, really now 2 consecutive historic earnings seasons in terms of strength. I mean, the median company is growing their earnings 14% year over year. We haven't seen that in years, and that's not even talking about the outliers in tech that are growing their earnings much faster. So strong earnings is actually making the fact that with rates going higher, the market has become cheaper, right? Because you're getting multiple compression there rather than expansion. So it's one of the reasons why our target for the S&P has not changed, by the way, throughout the year. It's been at 7,800. We briefly touched that a few days ago. We haven't come off of that. So we think 7,800 is the level, is the target for the S&P 500. We think that given the sort of support we're seeing from the earnings side, rates at these current levels are not a problem. They will become a problem, though, if they go much higher from here.
Okay, so we have an S&P that's just below 7,700 right now, but as you said, we had the S&P above 7,800 for a brief moment in time earlier this week. What does that mean for investors who are sitting here thinking, well, why would I invest in stocks right now then if we've seen the majority of the rally? Why not just invest in bonds?
Right. Well, look, that's a very compelling argument, and I think bonds have actually become much more attractive compared to equities, especially given the recent moves. Right. It's very rational for an investor to say right now, look, the U.S. 10-year is paying me 4.7%. The equity risk premium is around 5% or so. I'd rather just take the 4.7% with the lower volatility on the 10-year bond rather than the volatility of the index. So I think the case for bonds is becoming much more compelling, and we would be rotating into bonds right now. However, if the case for equities in the long term has really never been stronger. So I want to make that point. If you're a short-term tactical trader or tactical investor, if you want to call it that, and you're trying to sort of time this market, yeah, maybe it's not such an attractive moment to get in. But if you're a long-term holder, if you're looking out, 5, 7, 10 years, the equity market continues to be a very attractive place. U.S. companies have never been better at making money than they have been right now. So I would even argue that historically, you would say, right now the S&P is about a 20 times multiple. It's not expensive, but it's definitely not cheap. I would argue that given the rate of earnings growth, that's actually not a necessarily bad level longer term to get in here.
All right, quick break. It's summer, and that means it's high spending season. Vacations, weddings, Aperol spritzes, al fresco dining. Basically, I know I'm going to spend more in the summer than I do the rest of the year, until Christmas. What I want to know is whether I'm still on track financially. That's where today's sponsor, Monarch, can be helpful. It brings together all of your bank accounts, investments, credit cards, loans, and recurring bills into one clean dashboard, so you can see your spending, net worth, upcoming bills, all in one place instead of bouncing between apps. I also like that it separates fixed expenses from flexible spending because it makes it really easy to see whether a summer splurge actually matters or if everything is still on track. And the AI-powered insights explain what's changing in your finances based on your real data. Just to be clear, once again, this is demo mode, not my real data. Monarch is private and ad-free. You're the customer, not the product. It syncs with more than 13,000 financial institutions and works across both web and mobile. If you want an easy way to check in after a big purchase or just to get a clearer picture of where your money is going, check out Monarch using my link below and use promo code STREET50. That's promo code STREET50. Let's break that down a bit. First, You talked about rotating money into bonds. Where is that money coming from? What areas of the market are you taking profits from to put into bonds? And then we'll get into what areas of the market you'd be investing in right now.
Yeah, so if we look at it just at let's say the asset class level, on the equity side, I think it makes some sense to take some money out of the best performing sectors, some of these sort of, some parts of the AI complex that have done well and rotate it to some of the cheaper ones. We also like Europe. This is not really a story that has been told too much recently, but Europe is actually growing their earnings relatively close to the median level that the U.S. is. This is something that hasn't happened in years. And given how cheap they are, we think, that's a particularly attractive place. We also see, some opportunities in certain emerging markets. We like LATAM, ex-Brazil, many countries down there. Some of the Asian markets as well. India, I think, has re-rated to the point where it's pretty cheap. So there's equity opportunities beyond the U.S. and within the U.S. Now, in terms of sub assets, let's say bonds into equities, long duration, on the treasury side at these levels is starting to get very attractive. And is a point where we actually think the 10-year is going to end the year slightly lower from where it is today. The risk is that it doesn't, which is why that's my biggest risk. So, I think a US 10-year at 470, which is the level you're seeing today, is an attractive place to buy. Another place that I like very much is the tips market. The longer term tips, you're getting paid around a 3% real yield on 30-year tips paper. That basically means the US government is telling you, we're going to give you a 3% real yield over 30 years. If you're a pension fund, if you're a sovereign wealth fund, if you're a defined benefits plan, for example, that's a very attractive real yield to lock in for a very long term. So I'm assuming that they're coming out here and buying this pretty aggressively.
Going back to your international call for just a second, what's the best way for the average retail investor to invest in Europe and LATAM? Is it through ETFs or is it through stock picking within those countries?
Yeah, I would say through a diversified basket, either through ETFs or mutual funds. Remember, the average investor doesn't have the time to put in the sort of the due diligence that's behind, individual stock picking. So that is likely or should be outsourced to either professional manager, or if you don't find a professional manager that is worth the fees that you're paying, right? If they're not generating enough alpha, then you go through an ETF vehicle, like a regional vehicle.
So bringing it back to the US, what are your highest conviction areas of the market right now?
So we really like the healthcare sector, and it's been one of the sort of worst performing sectors. It's underperformed throughout the year. So you mentioned earlier, what would you rotate out of? Some take some money out of the AI complex, put it into healthcare. We don't think healthcare has even begun to really feel what the benefits of the dispersion of AI technology is going to be in the field. I mean, you saw the Moderna news just a few days ago. Mm-hmm. We think this is something that's going to be coming down the pipeline across the board because AI is radically dropping the cost of new drug discovery for these companies. So, and that hasn't been reflected in the price. The healthcare sector has underperformed the entire year. So we really like the healthcare sector. That's one that we really like, for example.
And what would you avoid?
So I won't tell you what we'll avoid. I'll tell you what we've switched. Over the last 5 to 10 years, the sort of Mag 7s, the hyperscalers, we've bought them for growth, right? And that's how we've generated growth in the portfolios. That's how we've generated excess returns. We've now switched, and we're using these hyperscalers as defensive positions within the portfolio. We don't think the growth is going to come from these names. We think that they're going to give you the defensive benefits, the ballast in your portfolio that when and if things go badly, economically, geopolitically, there's a market dislocation, those are going to be your stabilizers. So it's going to, investors, I think, have to start making that switch where they start seeing names like Amazon, Google, rather than driving growth in their portfolios, as actually being the defensive positions within their portfolios, almost like utilities.
Defending against what? A market downturn?
Yeah. We think those names will outperform if and when we go into recessions, when there's a market downturn. We think the outperformance will come from those names. When the market starts ripping higher, we don't think the growth or the returns will be driven by those names.
So if I'm sitting in an S&P 500 index fund where I have still a lot of exposure to the Mag 7 names, where am I still underexposed to the market that's really been broadening into a lot of other areas outside of tech?
No, that's a great point. You're underexposed to healthcare. You're underexposed to, or you're underinvested in energy, financials. So the way to play this, if you're an investor, is switch out some of your SPY potentially into the equal weighted index. For example, where you get access to the entire equal weighted stocks rather than a market cap weighted. So we think that's a play that for this year, for the first time in a very long time, the equal weighted index is outperforming the market cap. We think that's going to last for a long time. So I think that's a smart trade to make right now.
I know you can't talk or give individual stock recommendations, but I'm sure there are some people watching that are having some FOMO after seeing Moderna. As you mentioned, it was up, 175% yesterday. It's coming off today, but still up close to 400% year to date, and thinking, I have to find the next big winner. I want to find Moderna back when it was, I should have invested when it was back in the 20s, not all
Right.
that long ago. What
Sure.
would be your
Sure.
advice to people who are just really trying to, find the next name that's going to rocket higher?
Yeah, my advice would be don't play that game because that's not a game you can consistently win, right? You might get lucky here and there, but overall, it's not a game that you'll win. It's kind of like going to a casino. You know that the more you play, the more money you're going to lose. The smart way to do this is to get a diversified basket in healthcare, for example, that has underperformed, that is still cheap, despite what Moderna did a few days ago. Other names haven't had the same, let's say, up move, and we expect that they will because they're all going to benefit from becoming cheaper to do the research that in the past has, cost them so much money. So the way to do it is to buy a healthcare ETF, for example, rather than try to pick an individual winner, right?
Okay. We also, just to bring it back to tech, we have Nvidia reporting earnings next week. What's the number one thing
Yep.
you'll look at, or what's the number that you'll be looking at first to decide whether the AI spending boom is accelerating or starting to cool? And what would Nvidia have to say next week that would make you rethink the broader AI trade?
Yeah, look, so far this whole notion that demand for AI is cooling has just not been borne out by the data and has not been borne out by the earnings call. So it would be very surprising to us if Nvidia announced some numbers or gave some guidance that that was happening, and I'm sure the stock would suffer if that were the case. But more than that, I'm focused on these types of financing arrangements that they are doing. That is one potential source of risk in these markets. We don't think it's something to be systemically worried about yet. It's By the way, it's one of the reasons why rates have been going higher is because now the U.S. Treasury is competing with Google, Amazon, all these hyperscalers that are issuing long-term debt. So investors are becoming more discerning and demanding higher yield because there's been an influx of supply into that side of the bond market. So I'm going to be most focused on what are their sort of capex plans and what type of financing arrangements they are announcing or seeing in the future.
I want to ask you a question that one of our YouTube viewers posed. I think it was last week. And I think this is good because, a lot of the rotation that we talk about or take profits from here and put them here assume that you're already invested in certain things. So the
Right.
viewer said, if you had $10,000 and had to start your portfolio over from scratch, what would you do?
Well, I mean, a lot of that depends on, how and when do you need that money? Is this money that you're just sort of, saving away for, long term? If you're young, if you're old, right? So it's tough to tell an individual investor without knowing the circumstances of their profile what they should do with that money. Generally speaking, though, if I had to give sort of broad answers for this, and I know your audience wants an answer, I would say the younger you are and the more that's for kind of long-term savings, I would have a much greater percentage of those $10,000 should be in sort of broad equity indices and broad equity exposure. The more likely you are to need that money either for liquidity because you're going to start living from it, or you need it for to make purchases or something. The more you want to go into safe, stable things where the returns aren't as higher, but the volatility is much lower, right? So that might be a non-answer, but it's the best I can do, not knowing the particulars of that particular investor.
But if the goal is growth and the
Yep.
time horizon is years versus, 2 years to retirement, you would
Yeah.
put that money in the S&P 500 versus individual stocks?
Well, I would not just do the S&P 500 because I think you're at that point you are systematically underweight or underinvesting in markets outside the U.S. Now, the U.S. market is the best equity market in the world. Let's make no mistake about it. Like I said earlier, U.S. companies are better at making money than companies anywhere else around the world. But they're also relatively expensive versus some of those markets. So I would have a sort of a more global equity exposure. So something like the All Country World Index makes sense, which is already, by the way, if you buy the All Country World Index, about 60% is U.S. equity. So it's not like you're not getting U.S. exposure there. So I would look at global markets that haven't run up as much or aren't expensive as the U.S. So I would sort of go more globally than just focused on the U.S.
Okay. And just finally, before we get to rapid fire, you have a 7,800 price target on the S&P 500, which is higher than where we're currently trading, but not by much. So does that make you still bullish?
I mean, it puts me moderately bullish, I guess. I'm not like, salivating to get into this market if I haven't been in it right now, which, we haven't. We've told our investors to do so. We're also not looking for an exit. We think if we're going to be wrong, by the way, on that target, we think we're going to be wrong to the upside, meaning that the market will end up trading up higher precisely because earnings have been so strong. Now, what could derail that is rates and or the geopolitical. I know we haven't talked about Iran or Russia, but those are real risks out there that we can discuss. So I would err on, I'm moderately bullish, I should say, given what the environment is. But longer term, I'm quite bullish on the prospects for stocks longer term. Yeah.
So just quickly, tell us what exactly would make you boost that price target and what would make you cut it?
So what would make me cut it would be if I would see a rapid move up in rates or signal that the Fed, for example, is going to start a hiking cycle. I'm not talking about, one hike. Like one hike is already priced into the market. In fact, we got to a point where two hikes were priced in. That's come off a bit. So if the Fed were to make some type of announcement or communication, I know they're shying away from that, but if they were to sort of announce or telegraph that they're going to start a hiking cycle, 2, 3, 4 hikes, that would cause me to become more bearish. And if we saw an escalation beyond what we're seeing right now in Iran and or Russia, that would also potentially cause us to turn more bearish here. But we're not expecting that. That's not our base case.
And more bullish would just be continued earnings growth.
Correct. Yeah. I don't think the movement or the returns that investors are going to continue to get here for a while are going to be driven because the discount rate's coming down, because the multiple's expanding. We think it's going to be continued to be driven by earnings.
Okay, so if someone's looking at, the NASDAQ down, 2.5% this week, would you say that that's a dip they should be buying then, or you wait for a bigger pullback?
I mean, again, it depends what your time horizon is, right? If your time horizon is days or hours, yes. I mean, the answer could be absolutely yes. If your time horizon is 3 months, 2 months, probably not. If your long horizon is 10 years, absolutely yes, right? So there's a sort of a J curve here.
What if your time horizon is 2 years?
Of course, you had to give me a difficult question. We couldn't end with that. 2 years, it's more difficult, but I would say, I'll tell you, all right, so let me throw in a longer term concern that I have, which is why that 2-year period that you picked is particularly pernicious in my view. I have sort of high conviction that taxes are going higher in 29, regardless of who wins the White House or not, or what the breakdown is on the congressional side. And what I mean by that is I think corporate taxes are going higher. I think, there's, the potential for wealth taxes, and I think taxes on higher income groups are going higher. So that gives me some trepidation that 2-year window could be a window that's a little bit or has more volatility because of the issue of corporate taxes specifically. They are at historical lows. So these are low-hanging fruit for politicians to increase, whether it's Democrats or Republicans. I think, I have pretty high conviction that corporate taxes are going higher come 2029. So I'll say pending what I'm seeing on the political side, but, that's an iffy, tricky window because of this.
Okay. All right. We'll have to dig into that more next time you come on. I've been teasing it, so let's get right into our rapid fire round of this or that. Quick questions, quick answers, no hedging if you can help it. Are you ready?
Sure. Let's go. Let's do it.
Bringing it back to the consumer. Consumer, strong or slowing?
Slowing.
Stronger balance sheet, Walmart or Target?
Walmart.
More likely to weather a downturn, Lowe's or Home Depot?
Oh, this is a Home Depot.
Who's reading the economy right, the Fed or the market?
The market.
Recession in 2027, yes or no?
No.
Next 12 months, stocks or bonds?
Both?
If
I had to pick,
higher upside,
if I had to pick one, I
more
would
returns,
say
stocks or
bonds.
bonds?
Bonds.
Bull market, intact or fizzling?
Intact.
Broadening continues or mega cap comeback?
Broadening continues.
Stock pickers market or index funds?
Stock pickers market.
Market cap or equal weight?
Equal weight.
I know you'll say both, but US or international?
I do want to say both, but if I had to choose one, international.
Europe or LATAM?
LATAM.
Bitcoin above 70,000, opportunity or trap?
Well, we like Bitcoin here. We have an $80,000 price target here in the short term. So, I think it's still an opportunity if it's at 70. Yeah.
Best place for money in the US?
Best place for money in the U.S. In terms of equities, bonds. Give me something a little bit more here.
Sector play, equities.
Oh, sector play. Healthcare.
One word to describe how you're feeling about the market between now and year end.
Good. Like with a shrug, sort of like, kind of lukewarm. We're kind of near our target, so we're not super excited, but we still think there's, some upside here into year end.
And just to reiterate, S&P price target by year end.
7,800.
Ahmed Riesgo, Chief Investment Officer, Insignio. Thank you so much. Really appreciate you playing along.
No, thank you for having me. Appreciate it. It was fun.
If you enjoyed this Street Talk, check out our full interview with Dryden Pence. He reveals the stocks he's buying on the dips.